Today, we're digging into a story that you might not expect. It's about the incredible, long-term boom in the Indian stock market. Seriously, it's a story of resilience, hidden forces, and just massive growth that, honestly, often flies under the radar.
All right, let's just jump right in with a number that is, well, it's staggering. Over the last 25 years, Indian stocks have returned 1,750%, and that's in US dollar terms. No, that is not a typo. A performance like that really demands an explanation.
Now, let's put that into perspective for a second. During that exact same time, the US market, the one that gets all the headlines, returned a very respectable 640%, which is great. But India's performance? It's in a completely different league. We're talking nearly triple the return of the world's biggest economy.
So, this brings us to the big question we're going to tackle. How on earth did this happen? What are the mechanics going on behind the scenes that are driving this explosive growth? And what makes the Indian market so uniquely durable, especially when global markets get shaky?
Okay, so the first piece of the puzzle is actually found inside the market itself. It turns out there's this fascinating push and pull dynamic at play, almost like a built-in balancing act that works as a powerful shock absorber against chaos.
To really get this, we've got to look at the big players, the institutional investors. These are the giants. We're talking mutual funds, pension funds, insurance companies, the ones that move enormous amounts of money and can literally shape the market.
And in India, these big players are split into two main groups. On one side, you've got the foreign institutional investors, or FIIs. That's the global money coming in from outside the country. And on the other side, you've got domestic institutional investors, or DIIs. These are the homegrown Indian funds. And here's the key. They act very differently.
Research pretty much shows that foreign investors, the FIIs, are driven by short-term profits. They're trading-oriented, which is just a way of saying they tend to jump in and out of the market more often, chasing quick gains based on whatever the latest global trend is.
But in sharp contrast, the domestic investors, the DIIs, well, they're described as investment-oriented. They're playing the long game. They have a longer-term vision, they invest with more patience, and they often become this calming, stabilizing force, especially when foreign money gets nervous and starts to bolt for the exits.
So you can see this fascinating dynamic taking shape, right? You've got one group that's all about the short-term trade and another that's focused on long-term investing. So what happens when you put these two completely different mindsets together in the same playground?
Well, the result is just perfect. Over a whole decade, the correlation between their investments was negative 0.92. Now that's a really technical way of saying they basically do the exact opposite of each other. When foreign investors are selling like crazy, domestic investors are usually buying. When one group zigs, the other zags. They just perfectly counterbalance each other, creating that incredible stability we were talking about.
But look, that internal market dance is only half the story. To really understand the rest, we have to zoom out from the stock market and look at the sheer power of India's actual economy, which honestly acts like a kind of fortress.
Just take a look at this breakdown of India's GDP. A massive 60%, comes from private domestic consumption. That's just people in India buying things. Exports are important, sure, at 22%, but they are not the main engine. What this means is that India's economy is fueled by its own people, which makes it way more insulated from things like global trade wars or economic slowdowns elsewhere.
And there are these deep structural reasons why this is the case. First, India has one of the world's youngest populations. That's a long runway for future growth. There's been a pretty consistent political focus on the economy across different governments. We've already seen how domestic investors are a huge stabilizing force. And get this is a key fact. Only about 6% of Indian household money is in the stock market. Compare that to over 40% in the US. That just hints at the enormous, untapped potential for future investment.
So that's the big long-term picture. But how are these trends actually playing out on the ground? Let's take a look at a forecast for the economy in late 2025 to see these forces in action. These projected numbers tell such a clear story. I mean, look at the winners. Cement and housing finance are expected to just boom. We're talking net profit growth over 300 and 500%. What do those have in common? They are tied directly to domestic stuff, infrastructure, building, people buying homes. It's a perfect example of that internal consumption engine just firing on all cylinders. And here is another really crucial piece of the forecast. By October 2025, food price inflation is projected to be negative. So why does that matter?
Well, falling food prices put more money back into people's pockets. That boosts their spending power, which then fuels that domestic economy even more. It's a really positive sign for both stability and growth.
Okay, so we've seen the internal market balance, and we've seen the strong domestic economy. What does it all mean as we start to look ahead to 2026?
Well, the general feeling among market experts is pretty optimistic. While 2025 might be kind of a modest year, the expectation is that 2026 is going to be much, much stronger. And the main reason is that corporate earnings growth, which is what really drives India's market, is expected to pick up steam again.
Of course, no market is a sure thing, so a balanced view means we got to keep an eye on potential headwinds. Things like, what if U.S. tariff policies change? What if that all-important domestic consumption recovery stalls out? Or what if inflation stays sticky and delays interest rate cuts? There's also the chance of corrections in smaller company stocks after their big run-up. All things to watch. So, when you boil it all down, the crucial takeaway is this. What we've uncovered is a powerful 1-2 punch. First, you've got that unique balancing act between foreign and domestic investors creating stability from the inside. And second, you've got this massive, self-reliant domestic economy that just isn't as dependent on global trends. And those two things together, they create a remarkably resilient market.
And all of this leaves us with one last fascinating question to think about. With its low connection to global markets and its own powerful internal engine, is India's economy finally decoupling from the rest of the world? Can it actually chart its own course, no matter how turbulent things get globally? That is the big question that everyone's going to be watching for years to come.